We're going to get started. We're going to be recording this, so I figure if anyone comes in late, they can watch the replay of it. We know your time is very valuable. We've been working on this for the past couple weeks, and we think we've got a good one today. So, as you guys, if you haven't met Eli, this is Eli Christensen. No relation, but a very similar name. He's another one of our financial advisors, been with us for a couple of years. So I'm going to share my screen here, and we'll get started. Okay. All right. Well, thanks for being here today. Um, we're going to kick off today talking a little bit about a recap from last year. Talk about what we've gone through. We're going to be having about 30 minutes of content between Eli and I speaking, mainly covering economic updates regarding key financial indicators like unemployment numbers, GDP, and things like that. And then we're going to actually switch over and actually take some questions towards the end. As we're going through this, if questions pop up, we have two ways you can do it. One, you can just put it in any question you have in chat, or there's a Q&A button that you can toggle on as well. So feel free to fire those off as we go along, and we'll answer those towards the end. So let's get started. So just a quick recap of last year. We started off last year, market was up 3 to 4% going into February 19th. We had a pretty major drawdown, and that was mainly due to President Trump launching 20% tariffs across the board. Uh, uh, Analysts, economists, us, were not expecting such a rigorous agenda, and that caused the stock market to drop pretty steeply. From February 19th to April 8th, down about 18.7%. And then on April 9th, President Trump basically put a 90-day moratorium or delay on those tariffs, and the market ripped from pretty much from then on through year end. So you can see here, I'm showing you this mainly for just a quick reminder. The worst day of that drawdown, down 6%, and then the best day, 3 days or 5 days later, up 9.5%. So historically speaking, when we have market volatility, large drawdowns are usually followed by large upswings. And that's, again, important to keep in mind and a good reminder to stay invested. Another thing, if you look at the drawdown that we had, so down 18.7, up 38.7. Stock market ended the year up just shy of 18%. But just a reminder around volatility, if you look at that full down 15 from January through April and then up 38.7, that's almost a 44%, almost a 54% swing in market returns in last year. So again, just a quick reminder to stay invested. We don't want to ever have short-term volatility steer us away from our long-term economic and income goals. Just looking at how frequent volatility is, it happens every day, as you guys know, up or down. On average, we have about 3% declines in a year, about 5% declines, one correction a year, which is 10%, 15% correction every 2 years, and then about every 3.5 years, we have a 20% correction. So last year, we had almost a bear market. We're just shy of that last year. This is pretty much the same data, but looks different. And I know this is my favorite slide. I show this, I think, every event we do. And again, just a reminder. So if you look here, the even line here, you can see there's many more bars that are above that even line and fewer on the downside. So you can see here, going back the last 46 years since 1980, stock market's been positive 35 years, declines 11 years. So that's a win rate of about 76% of the time, which is pretty amazing. If you look at these red dots, that is the intra-year drawdown in any given year. And you can see it happens every year. So volatility, for those of you who have been investing a long time, you're familiar with it. For those of you who are newer, this is just a common thing that we go through to get to grow money over time. You're probably wondering why I'm talking so much about volatility. Well, it is the second year in Trump's presidential 4-year term, and historically, this midterm time frame, historically, we have the most volatility. So on average, down about 17.5% in a midterm election year. And if you look at just the last two have not been great. 2018, under Trump's first presidency, had a pretty good year through almost Thanksgiving, and then Chairman Powell had interest rate hikes going into December, and had a pretty mean pullback in December. I think we're down about 6% on that year, and then 2022 coming out of COVID and too much stimulus money in the system. Inflation went from basically 2% up to 9.1% over that year and a half time frame. And Chairman Powell raised interest rates at a really quick pace to about 5%. And stock market was down almost 18%. NASDAQ was down about 40%. Interesting thing to look at though, after those lows, basically going out a year after, you can see here pretty strong performance coming out historically from those drawdowns. Okay, looking at the economy, we're going to look at just some key indicators here. Looking at GDP, so just growth of the U.S. economy. You can see historically going back to the last 24 years, we've been growing plus or minus 2.3%. Sometimes we're above that, sometimes we're below that. If you look at where we are over the past 2 quarters, we're seeing a little bit of acceleration. So Q2 up 3.8%, Q4 up 4.3%, and it's looking like some economists have been estimating potentially 4% growth for the whole year. It seems maybe a little lofty, just for the fact that we have such a massive economy. To be growing at that high of a rate would be something to see. We'll have to just keep an eye on the numbers. But so far, since the beginning of the year, things are still looking pretty good. So looking at earnings growth, and again, earnings drive stock market performance. And if we look at just so far this year, 75% of the companies who have actually reported earnings so far this year have beat, and the average earnings beat or revenue growth has been about 15.3% so far this year. So far so good. Only 35% of companies have reported, so we've got a lot to go, but so far things are actually looking really good. Looking at growth last year, uh, just over 11% last year for earnings growth. Expected for 26 and 27 is 15%, which is absolutely amazing. Going back since 2001 to 2024, we've averaged 7.3. So you can see the last couple of years have been really strong, and still looking like some good tailwinds ahead of us for earnings growth. Looking at this chart here on the right, the gray bars are recessions. So you can see we've had 2 recessions. '08 was far worse than what we went through in COVID. But if you look at that from a linear standpoint, you can see just kind of a nice projected growth historically over time, because U.S. companies have actually got, even despite tariffs, they've been extremely nimble and have been very efficient, and was able to continue to grow earnings last year. Looking at company profits, we think we're in an economic boom globally. It's not just the US, it is Europe, and Europe's expected to grow 11%, Japan almost 9, emerging markets. And emerging markets, that's going to be Taiwan, Brazil, Mexico, and in even South Korea and into Africa, growing by 17%. China didn't grow last year. They're expected to grow 11.2%. Why this is important is if all major economic engines globally are working and are growing, their earnings growth is growing, it helps all parties. And just to give you an example, people in Europe and Japan and China, even if they are making money, they're going to be spending more money and they'll be buying more iPhones, traveling more potentially to the US and elsewhere, and likewise with us. So just a little bit of interesting information around the wealth effect. If you look at the wealth effect, that's just basically as our portfolios values go up, generally investors end up spending more money. It's not a lot. For every dollar of earnings we receive on our portfolio, we end up spending about 3 cents. That doesn't seem like a lot. When you factor in the U.S. economy or U.S. stock market's about 67 trillion, and if that goes up by 10%, that's roughly $6 trillion. That the number of spending is in billions from what we actually end up spending based upon that wealth effect. So there'll be a global wealth effect across the board. So we're pretty optimistic from the global outlook that will help all parties. Inflation, that's an issue. Definitely, if you look at where we've come from, we had very low inflation pre-COVID, and then during COVID, there's, as you all know, lots of economic safeguards, lots of extra money being sent out to us Americans to help reduce the chance of a recession. And Americans are really good at spending money. And so what happened was that money that was sent out was spent, and that's basically the definition of inflation is too much money in the system chasing too few goods, and it caused everything from homes to cars to spaghetti sauce go through the roof up to 9.1%. And then in 2022, Chairman Powell came out and raised interest rates from 0 to about 5%, and that's what caused that drawdown in 2022. So looking at what's making up inflation, if you look over here, biggest thing is shelter, and that's a big issue not only for younger people, but for those that are people those citizens that are renting and not currently in a home. And that's something I think housing is the one economic engine that's not really contributing to GDP. That's a hard one to fix for sure. And then, as you expect, being in America, dining and recreation is the other one, is the second largest spend. So 2.7%, to put that in perspective, GDP, both core CPI and headline CPI, 50-year average is 3.6. So we've come down off of those highs. Unfortunately, I think you know this, but I'm going to say it anyways. Inflation, that doesn't mean, with inflation coming down, doesn't mean prices are going back to where they were prior. Unfortunately, it's just that 2.6, 2.7%. That's just the rate going forward of prices going up. Wages, currently wage growth at 3.4%. Looking at the 30-year average, we're slightly above that at 3.6%. Unemployment rate, 30-year average is 5.5. We're currently at 4.4. The not too bad, but you can see here we were down as low as 3.9, and it's slowly been picking up over time. So the economy has fewer jobs available recently. So have seen that ticking up, and that's something that definitely a concern that we're keeping a very close eye on. Consumer finances. Consumer finances, things are actually looking really good. If you look on this left-hand side, us as Americans collectively, we have almost 203 trillion in assets. And historically, going back the last couple of decades, homes used to be the biggest piece of our wealth. But over the last decade or so, it's become financial assets, pensions, deposits, etc. Liabilities, us again as Americans, we're running pretty clean balance sheets across the board. Only about 21 trillion in liabilities, so roughly 10% of the assets. I would just wish our government ran a little bit more as efficiently like we did. So as a whole, consumers are pretty good. You can see here the biggest debts people have is their home, good debt, able to actually build wealth, grow equity, as well as have a place to live. Student loans 9%, car loans 7, and credit card debt roughly 6% across the board. Top right, real quick. This is the household debt service ratio. That is the amount of money after tax that is spent on mortgage payments. So you can see we got down really, really low just after COVID, and now we're at 11.6%, which again, historic, still close to historic lows. Why that's the case, how that happened is during COVID, pre-COVID, and into 2020, 2021 before rates went up, mortgage rates were in the 3% range. For 15 years, they're in the 2% range. So majority of homeowners locked in very, very low rates. So that's why this is so low. It has been creeping up mainly because people are upsizing houses and a little bit. So that's going up a little bit. Why this is important is if a family is having difficulty but they have a home, we've seen massive amount of equity grown in homes. They have another lever they can pull. Worst case, they could always do a cash out or a home equity loan to get a little cash to get them through maybe a job loss or something like that. This bottom right is one we're keeping a close eye on. This is one again. This is the concerning one of these three charts. These are early delinquencies going in 30-day delinquencies on these different categories. So mortgages, 3.6%. Student loans through the roof. You can see main reason for that is there was a moratorium where in a period of time where people that have student loans didn't have to pay them back and they weren't being charged interest. That changed, and then you saw a massive amount of defaults. Credit cards, about 9% of credit cards are 30 days late, and car loans, about 8%. So if you average those together, we're actually now just above where we were prior to COVID, prior to the pandemic. So it's something we're keeping an eye on. We're almost in a tale of two economies. Those middle class and upper class people that have own a home, they have and have money in 401ks, et cetera. They are doing better, feeling better about things. People that are on the lower end scale, they're renting. Unfortunately, they didn't participate in the run up in the stock market, nor do they have equity to build. Those folks are definitely in a bad spot. And again, tough one to know how to actually fix that, but something hopefully we can figure out. Tech expenditures. So this is really important. This is a key theme why we think we're going to have a pretty good year this year. If you look at just economic expenditures or expenditures from these hyperscalers, you're looking at massive amounts of money being spent on AI build out, data centers, et cetera. So you can see here from 2023, massive, almost 40% increase to 239 billion. Last year, about 390 billion spent, and then forecast for this year is 515 billion. So it's important to remember one company's expenditure is another company's earnings. So this money's being spent, and companies are other companies that are actually taking in profits are doing extremely well. They come from companies like NVIDIA, who are making microchips, companies like Micron, which does memory for AI, but also construction companies that are building data centers, Caterpillar for earth movement for this. So lots and lots of areas are doing really, really well in this regard. And just looking at the size of it, 515 billion being spent, that's the size of a economic stimulus package from the government. That's massive amount of assets that's being spent, and we think that's a big tailwind going forward for the next number of years. Artificial intelligence, we get this question a lot. Are we in a bubble? Well, let's just look at it. Two different charts here. Left-hand side's looking at the tech bubble back or internet bubble, excuse me. And you can see here in green, That's actually stock market growth. The blue here is actually earnings. So you can see that bubble. Stock market prices were way, way above earnings of those internet companies. And that's why we had the crash. March of 2000, things started to evaporate and start drawing down. If you look at us here, you can see again earnings in blue, stock market, we're trending really, really close. We did that correction we had in February through April last year. And this is one of the reasons why we say pullbacks are normal and they're actually healthy. We're getting a little above, but see how we dip below, and then since then we're tracking fairly close to earnings. So we don't think we are in a bubble. We think over the next few years we'll probably be building a bubble, but until then, we want to be able to participate as much as we can in this economic growth. A lot of people ask, going back to the internet bubble, 2000 again was when things started to go down. Where are we now? Are we in 1995, 1996, 1998, et cetera? Hard to know. Dan Ives, he's a economic analyst following mainly the tech sector. He thinks we're in 1996. So that would say we've got 4 years or so to go before things we get into maybe bubble territory. Um, as you all know, we're watching things not yearly but daily, and we'll be making adjustments along the way. Okay, just to sum up everything I went through, here's our forecast for this year. We don't see a recession. It's very, very hard to have a recession when you have, again, every major economy growing. So we don't think we'll have a recession. Economic stimulus, that build out I just mentioned, that's that tailwind. Another tailwind is just looking at for business owners. There's the new tax bill, accelerated depreciation. What that means, if you're a business owner, you can actually have a clean runway where most likely no new regulations to slow you down, but also the ability to actually spend money on your business and get a write-off. So if you want to buy a new building, instead of having to depreciate that over, say, 40 years, you could do it all in 1 year. Buying more equipment, more maybe upgrade computer system, whatever it is, you can depreciate it all in one tax year. And that unlocks a lot of economic activity. Also, in that tax bill, the tax refunds are supposed to be up quite a bit. Again, $675 to $1,000, what they're saying isn't a ton, but if you amplify that over households across the board, that's quite a bit of extra money that's going to be spent in the economy. Strong corporate earnings, again, looks like 15% for the year. Stock market's generally following earnings. That's another reason. And then that global economic boom. So here's one thing we do believe, high chance, just it being a midterm election year. Also, there's a ton of stuff going on politically. We think there's a decent chance we might get a 10 to 15% correction sometime this year. Who knows? That might be happening soon. The last couple of days have not been fantastic. Um, some highlights on maybe why higher inflation. If economy is growing strong, inflation could tick up. If it does, we may not get as many interest rate cuts. Global uncertainty, just with Greenland, with some of our major trading partners not being so happy with us. Who knows what might happen there? China as well. Increased tariffs, potentially. Also, maybe Supreme Court. We've heard a lot about this. Could possibly repeal the Trump tariffs as a whole. And then this is more of a recent one, just a reassessment of AI winners and losers. If you've been paying attention to the software market, it's in about a 40% drawdown so far this year. So that's companies like Salesforce, Salesforce.com. I'm blanking on a few others, but Adobe's another one. Microsoft's been getting hit a little bit as well. So the risk around that is um, Perplexity is an AI engine that's able to build software very, very quickly, and it's scaring a lot of investors thinking that maybe a Salesforce.com might get put out of business. Our opinion is it's hard to unwind a massive company with software that they've spent time building out. To just turn that off is very hard to do. So we think it's a little bit overdone. But those companies they have to work harder. They need to innovate to be able to keep those clients. If not, they could potentially be a loser. So bond returns 4 to 5% for the year. I'm keeping this one wide open. We do think it'll be a positive year, saying 10% plus. On the upside, just hard to know. It's hard to know. It's a guess at the 10% plus as it is as well. I'm done. So I'm going to turn the time over to Eli. He's going to pick up from here and talk a little bit about stock market metrics and some of our portfolio positioning for 2026.
Well, awesome. Thanks, Parker. Yeah, so now we just heard from Parker. The economy, is healthy. People have been able to make that transition from the high inflationary period and that transition coming back down, and a lot of changes. But ultimately, the big question is, how does this translate into market returns? And even more important than that, how does that translate into all of your guys' portfolios and what we're doing as far as asset management goes? So there's a few things that we'll look at. So Parker, if you'd be able to go to the next.
Yeah.
So the first thing, if we can't really talk about the market without talking about the Mag 7, because that's really what has driven the market returns over the last few years. So if you look going back from 2021 through the start of this year, so what you're looking at, the S&P 500 as a whole, but really the two lines to look at, the S&P 493, basically taking out the Mag 7, and then comparing those returns. So the rest of the market in 21 did 23%, the Mag 7 did 40%. And you can see going across there every year, the Mag 7, aside from 2022, where it had that big drawdown, the disparity between returns is huge, right? It is really big. It's not that the rest of the companies aren't doing well. Those are great returns going from 11%, 14%, and so forth. But the size and scale of those returns have been outsized. And really, that is primarily due to the slide that Parker had shown earlier about earnings, because it's all about the earnings. We look at NVIDIA and Microsoft and so forth. They've had great returns, which are good earnings, which they have, obviously, people are going to participate in that. So what we're really looking at, if you can go to the next slide, Parker.
Yeah, sorry.
Stay on that one. Yeah. And then going across the board here, year over year earnings growth, same thing. They've earned it, right? They've had great returns, but they've earned it because they're making the money. Now you can kind of see going into the tail end of this year, of last year, and coming into this year, there seems to be kind of what Parker had pointed out, a little bit of volatility, a lot of movement that's going on in the market. And that's just because we're trying to reassess and go over what it is that, what's that next phase, right? AI is a great boom. There's, NVIDIA and so forth. They've been creating great earnings, but now we've kind of priced them into where they should be. Go to the next slide. So where is that opportunity, right? So they're making and pulling in billions and billions of dollars. Really, opportunity is about trying to predict where those dollars are going to be going next, right? And we see that opportunity expanding across various parts of the economy. If you've heard us in our review meetings, we talk a lot about infrastructure, and as well as those being able to actually utilize AI. We haven't seen a big adoption. So if you go to the next slide, what we saw, if any of you remember from last year, probably not, but the total adoption rate. So if you look on the left-hand side, businesses using AI, that total amount of companies leveraging AI was at 10%. It's now at 18%. So yeah, it's a huge move, 80% move. However, it's still only 18%. So there's still a lot of room and a lot of growth to go. And that just tells us, all right, there's going to be companies that are going to know how to leverage AI to make sure that they're more efficient and get better earnings. So for us, when we're looking at this, we're saying, okay, what are those companies? Not only from a sector perspective, but inside of those sectors, which ones are going to know how to leverage and move? If you've kind of watched the market over the last few days, you've seen a lot of software application companies get really beat up. And that's primarily due to people wondering how AI is going to affect those software applications. And for us, we look at that as many of those companies that have kind of had this big pullback. There's a lot of opportunity hidden inside of there. Because number one, from a time perspective, it takes a while for the adoption. And it takes time if somebody wants to change out an application, right, across big organizations. So we feel, and then there's going to be big companies that will know how to adapt to AI to help enhance their business. I just saw an interview of the CEO for LegalZoom. They got hard pullback yesterday because Anthropic came out with a new AI bot to help out with legal matters. And so people thought, well, that could be a big pullback. That could be tough for LegalZoom. However, the CEO got on today and was saying this could actually be a big benefit to them. This could actually drive more adoption into what they do. And so you see this, and then of course it's moving more to the positive today. So you're getting kind of this movement and volatility, people trying to figure out, okay, where is that opportunity and what companies are going to know how to adapt and adopt. And Parker had said this earlier, I think we're going to continue to see a little bit of that volatility and that movement, trying to predict and understand who those winners and losers are going to be in this race. So you go to the next slide. So the next, because I think in general, I get a lot of questions where it says, the market's been doing really well over the last several years. Can it keep going? Right. And I think it's all depends on how you look at it, right? If you look at just simply the S&P 500, it looks like things just keep moving and taking off. However, built inside of there are those winners and losers, right? As we saw, the big winners that really drove the market were the Mag 7, those that were building out AI, right? And so now that next big move is going to be, okay, where inside of that are we going to be able to get those returns? And if you look at longevity just in general, if you're looking at kind of the broader picture and saying bull versus bear markets, we're still very early. We had brought this slide up last year talking about this because we had kind of the same conversations. People saying, hey, the market's doing really well. Can it do it again next year? So the exact same conversation. And so, we're going to show this slide again. Your average bear market lasts for 70 months. Bear market's 14, right? So we are still very early in this adoption. So if you're looking back at our recent bear market compared to the others, just as Parker was circling there, we're still early. And given the fact that there isn't much of a disparity for earnings versus the market growth, again, still early. I'm not a big fan of everybody keeps comparing this to the .com era. For me, I feel like there's no real comparison, simply because I think this is something drastically different. And not only that, but since the markets continue to get more and more efficient, we don't see that massive disparity between earnings and growth of the market, and that big separation. So I think we still have a long ways to go. You're still going to experience some volatility, but you got to know where to find those opportunities. I can go to the next slide. So this is what I wanted to talk about when it deals with all of, your guys' accounts specifically. So back in December, Parker and we were talking through this, trying to figure out, okay, how should we position ourselves going into next year? Where do we see those opportunities? And really, it came down to really three main areas. So the first is looking at value. A lot of companies have been able to ride that wave of AI. A lot of those growth companies, a lot of investment going into them to help build out their platforms and development. And that's great. We rode that wave. But as people are looking around and trying to figure out where those opportunities are, they will tend to sell out of those companies that they have made those big gains on and then turn around and say, okay, well, I'm going to sit on the sidelines, right? I'm going to flee to safety, as we've heard it before. And in the past, as interest rates were high, that flee to safety was into treasuries, right? But now since treasuries and the returns have started to drop, that flee to safety, a big chunk of that allocation is now moving towards value. If you look at the markets right now, your growth, the S&P 500 growth is flat to negative, whereas the Dow Jones is positive 3% on the year. So it's not, the overall market where people are moving is that lean towards safety and lean towards value. So for us, we made a lot of different changes. So in your portfolios, you'll see like SCHV, we kind of shifted towards that. We've had that in some of our portfolios, but we added a bigger allocation to it. It doesn't mean that we leave growth and we leave the Mag 7 completely, but we start to shift that allocation and lean it towards value a bit more. So we're looking for companies with good earnings, good cash flow, and dividends as we look to broaden out the market. The next is, okay, well, we have the value. Where are we going to get that growth? And we find that we need to be strategic with this growth. And the two areas where we see it the best is going to be in that industrial spending, right? That infrastructure. Because as the slide that Parker showed with the AI spend out and infrastructure build out for AI is in 500 plus billion, and it's just going to continue to go up. Not just this year, but the years to come. So, where you get value increase or increase in stock prices is when more dollars are chasing specific companies. So it's more about the flow of money than it is just simply saying, oh, this is a good company, right? We need to see where those investments are going. So that $500 billion is going to infrastructure, right? It's going to laying the concrete, the piping, the wires, and so forth to make sure that this AI build out will be sustained. So one of the positions that we added actually mid part of last year, and then we actually added even more so going into this year, is AIRR. So you see, as of end of day yesterday, year to date was already up 17%. So we've been able to capture on that. And last year it also had a great run. And we see that continuing on as that spend continues to build. And then the next area that we see where we can get some growth is in small and mid caps. And there's three reasons for that, really. One, as AI gets built out and adopted, they'll be able to be more streamlined, more productive with their dollars. The second reason is that they're going to have cheaper dollars, right? Apple doesn't necessarily care that the Fed, lowers rates, by a quarter point, but who does care are going to be your small and mid cap companies, those that can borrow money at a cheaper rate to reinvest and get a better return as a company as a whole. So if you've seen, so this is another position that we've added, GRNJ. It's more of an actively managed small and mid cap growth fund. And year to date, it's up, 6%. It's had some of a pullback over the last few weeks, was I think up, around 14% at one point, but still up, 6%, 6 times what the rest of the market is doing. So these are the kind of things that we're starting to add to the portfolios. We're trying to be as strategic as possible. The last few years, it's been pretty easy to simply go, yeah, we need to be in technology in general, and be in the Mag 7 and ride that wave. I think the rubber meets the road over this year and into the next few years is being able to be smart about where we're deploying that capital and not just simply just being in the market. So, yeah, with that said, it's been nice to have the reviews with our clients lately. I've had a couple this morning talking about returns. A lot of our portfolios are outperforming simply because we're focused really heavily on these three areas, leaning more towards value and finding the growth in infrastructure and industrial spending, as well as those small and mid-cap companies.
Perfect. Thanks, Eli. Thanks for that. Just a reminder, please send over any questions that you might have. Currently, you only have one, and I'll answer that and give people maybe a little bit more time. So question here, asking, please provide an update on Presidio. Good question. How many employees and what volume of money are we managing? Yeah, great question. So we have 6 employees, so we're fairly lean and mean. We manage about 230 million in actual assets in regards to wealth management, and then we're also advisors on 401ks as well. We do 401ks for about 30, some of the smaller ones, about 40 companies, and if you add that all together, we're just over 300 million in total assets under management. So, and thank you for that, all of you who have been working with us for a long time. We don't take that lightly. We appreciate you working with us and all the many people that you've referred to us as well. So thanks for that. We have a couple canned questions that we didn't have in the presentation. We'll address those. But again, hit us up if you have any specific questions. So just a couple, we'll just hit real fast. This is we're just off all-time highs. So if you look at it, the big question we get in our reviews over time is, hey, stock market's done great, and it has. If you look at the last 3 years, 2023 up about 20%, 2024 up about 20%, and last year up about 18%. But in doing that, you're actually hitting all-time record highs all along the way. So the question is, hey, I've got X amount of dollars to invest. Is this the right time? That's a hard question to ask, but if you look historically, and this is going back to 1988 to 2024, you can see here, if you are over a 5-year time frame, if you're investing at an all-time high, it's better than if you're investing on any other day. So up about 81% of the time versus 75 over 5 years, 3 years, 46 versus 40, and so on. So if you have I think the most important thing is if you have a long time horizon ahead of you, you've got 10 years plus, you're able to outride any market volatility. For those of you who are retired and who are relying on the money to be providing income for you, obviously we don't have it all in 100% stocks, and we have in a well-diversified portfolio. So again, don't be too scared of all-time highs. All-time highs generally means returns are begetting more returns, and that's generally how it works. Another one more for you guys. This is a big one. If you've been following gold and silver, it's been on a heck of a run. Talk a little bit about gold. Why is gold going up? Well, a lot of it's been central banks globally have been diversifying their balance sheets. They've been maybe buying fewer treasuries. Us U.S. citizens, we own majority of the U.S. treasuries, but also you've heard news recently with Denmark not being so happy with us. They were selling some treasuries. Also, China's been reducing their exposure to treasuries, and a lot of them are buying just physical gold. So that's what started it. And look, the last year, gold's up 72%, and this is a day or say old. Close. This is close. But look at silver. Silver's, in my opinion, is memeified, meaning there's a lot of money just flowing into it because it's going up, and it's sold off pretty drastically. Last week it was down over 20% in one day. So we are in a commodity boom again. As all those major economies are doing well, they're they're doing a lot more. So gold's one thing, but if you look at gold's been at record highs, gold hit record highs until it's pulled back. Aluminum's at record highs. Copper's at record highs as well. So commodities, metals across the board have been in an upswing. Part of that is that AI build out. So aluminum, again, record, copper, record. There's millions of miles of copper going into data centers, and replacement metal for copper is actually aluminum. So that's going in there as well for wiring, for racks, for all of it. Silver is also another connectivity metal for electronics. So I think silver's gotten way ahead of itself. Gold, we'll just see. Again, there's a lot. These are smaller markets, especially silver. It can get pushed around a lot. So I think you're going to see a lot of volatility on that going forward. Um, I don't know if I don't think I see any other questions. I'm going to check chat here real quick. That's it, everyone. So thank you so much for again your trust in us and our firm. We are energized every single day to get out of bed and come to work. We love what we do, and we love working with all of you. So thank you so much for that, and thanks for attending today.